Sincere apologies, please. So, the system just, misbehave, and we must do this lecture tonight. So, like I said, we're looking at ISM for those that are just joining us afresh. And that's cash flow statement. Is one of the topic you need to cover, and you should expect questions from them in your exam. So, in the last classes, we have looked at the definitions, the overviews, the formats that you need to apply. We have looked at the importance, we have looked at how it's been classified and the likes. And like I said, um, your operating statement, which is also known as the operating activities, plus your financing statement, which is known as financing activity, plus your investment activity, uh, plus the opening cash and cash equivalent, will always give rise to the closing cash and cash equivalent. And like I told us, one of the key importance of this cash flow statement is to compare the cash profit with the accounting profit. Accounting profit, there are so many adjustments before you can actually come by the accounting profit. But with cash flow statement, you know you can always know if actually an entity made good or quality profit, uh, or if they did not as well. And then also by cash flow statement, it's easier for you to know the ability of the managers of the business who will commit those economic resources of an entity into their hands to know how well they have been able to manage the resources, as it were. And so that's one of the importance of this cash flow statement. Now, we said in the last class that two methods can be used to determine the operating statement, that is the operating segment of the cash flow statement. In other words, we said that the cash flow statement has three main segments, can be classified into three main segments. The first is the operating segment, the second is the investing segment, and the third is the financing segment. And we said that two methods can be used to actually determine the operating segments. Now, for the investing and the financing segment, you don't need any method. The two segments remain the way they are. However, if you are asked to use the direct method, the only thing you do is you use direct method to determine the operating segment, and then seamlessly other segment follows the way they should be. And if it is to be the indirect method, you have to use the same thing apply. Now we have looked at illustrations how to demonstrate the direct method in our last class, and today we are looking at the indirect method and to determine, you know, the operating segment, the investing activities, or investment segment, the financing segment, as it were. Now, the format that we use under the indirect method is as follows. We said the profit before tax, or profit before interest and tax, as it were. You add back depreciation or amortization. If you have impairment on goodwill, this impairment on goodwill, certainly you will see it when we get to consolidated accounts. Impairment on goodwill, if you have it, you had it. If you have interest expense, that is finance cost, you had it. Now, the thing here is this. If you are using profit before tax, that is when you will add this interest expense or finance cost, as it were. But if you are using profit before interest and tax, definitely this interest you will have added it into the profit before interest and tax. Please take note of that. Now you also have loss on disposal. You had it. Increase in provisions, you also had it. Now all of these, the depreciation and amortization as well as provisions, they are non-cash items. The loss on disposal, the loss on disposal, they are the loss that is incurred when an asset is being sold. In other words, they are taken out of profit. Meanwhile, you should understand why you need to add it back is because that loss was not made from the ordinary business of the entity within that financial year. Then also interest expense, you have to add it back. Why? Because they are not to be taxed. You are not to owe taxes, as it were. And certainly when we get to the preparation what is it called? Before we get our cash flow, before changes in working capital, you will see what we do with that in that space. And then you list the following: investment income, this investment that you receive, income that you receive from your other investment, and then gain on disposal. You also list that is when you make a sale of an asset, whatever it is that you get from here, you are also going to lessen. Why are you lessening? Because you did not make that gain or that inflow from the ordinary course of business within the financial period. Equally, you have decrease in provisions. Provision simply means you are making an envisaged, expense, as it were. Now, provision, they are non-cash items. Usually, entities or managers or owners of the business use it to reduce their profit, as it were. So when we have a decrease, how do you get this decrease? Now, let's say the opening is higher than the closing. That will give you a decrease, as it were. And so that decrease, you will less it from the operating segment. Equally, you have government grant amortization. We did this under IS 20, where you use the what is it called? The income method, where you use the income method, where you are allowed to amortize the government grant over the period of time. Now, that when you are amortizing that government grant, as it were, that income that you recognize, you are going to add it back when you are doing your cash flow statement. And that will give us net flow from operating activity before changes in working capital. Now, the changes in working capital are here. When there are increase in inventory, receivable, or other current asset items, as may be specified, you are going to add it back to your net flow from operating activity before changes in working capital. And equally, when there is an increase in payable or current liability, as it were, you are going to also add it back. Then you list the following: where there are increase in inventory, receivable, or current asset items, you list them when there are increases. And when there are decreases in payable, current liability items, you're also going to list it, as it were. And then the tax that is paid for the period, usually there are adjustments on this tax paid. You make that adjustment, you list it, and that will give you what we call net cash flow from operating activity. And then this net cash flow from operating activity, you had the investment activity to it, you had the financing activity to it. Now, this will give rise to what we call either increase or decrease in the cash and cash equivalent. You understand now? Before you now had opening cash equivalent, cash and cash equivalent, and then this will now give rise to what we call cash and cash equivalent at closing. In other words, everything we are doing in cash flow, we must arrive at cash and cash equivalent at closing. If we do not arrive at cash and cash equivalent at closing, it implies that our calculation is not correct, as it were. So, like I said, we have looked at the example under direct method, and then tonight we are going to look, or today rather, we are going to look at illustration on the indirect method. Please, if you can hear me, just let me see your hands up as we proceed tonight. Thank you so much. Okay, thank you. Please, what we do is we quickly read out these questions, and then I'm going to set up another meeting platform, and then where we can easily join on tonight's class. So let's quickly go to the illustration on the indirect method. Illustration on the indirect method, and that is this. So let me quickly read. Don't go limitation of profit or loss for the year is as follows. Revenue is here. Then you have profit for the year, 134, 180. And then the statement of financial position is as follows. You have the assets, you have the current asset, you have the equity and liability, and then you have total to be 553,680 for 2020 and 425,190 for 2019. And in the last class, I was telling you that the reason why we call it balance sheet is because both equity and liability will equal to your net asset. So when they are equal, it means they are balanced. So that's why we call it balance sheet. Now you have additional information. During the year ended 31st March 2020, other comprehensive income was nil. A dividend of 85,870 was paid, and there was no disposal of non-current asset during the year. While I was speaking earlier, I know I said something about the fact that all that we are doing, we must arrive at what we call cash and cash equivalent in this very particular question. So let's really look at what exactly are the cash and cash equivalent. I think I will decide that later. So let's not waste time much in this particular question that we're looking at now. So prepare statement of cash flow using the indirect method of IS 7. Under IS 7, 10 marks. Calculate the company current tax current ratio as at the year ended 31st December 2019 and 2020. State 3 technical reasons which accounted for companies rising overdraft for the 2 years. Total is 15 marks. So if you see this kind of question in your exam, you should be glad that you are going to deal with them as you should. And that's that for that. So let's quickly go to the solution. Like I said earlier, the first thing first we're going to start it. Once you see an indirect method is profit before tax or profit before interest and tax. Now, we can use the profit before interest and tax. And how do we do it? All that we needed to do is as follow. If we go back to that question, we see it under the current under the income statement profit or loss account. We're going to see now we have it here. Profit before tax is 171,180, and interest paid is 17,120. Remember I said earlier, because the interest paid are always tax free, and then we are expected to add it back. What is it called? Management accountant. They will always remove it because they consider it as an expense, and then they went ahead and then they will go ahead rather and then take tax on it as it were. So please, somebody should help me puncture 17,120 plus 171 180 and tell me what exactly that we have. We should have 188 thereabout, please. Is somebody punching the calculator? What do we have? Can you hear me, please? Can you all hear me?
Hello, sir. What did you say we are adding, please?
We are adding 171 180, then 171 120. What do we have? Oh, yeah.
342 300.
No,
I'm getting 180 is 300.
300.
180 is 300.
Okay. One eight what? Are we see together?
180 is 300. 180 is 300.
188 300. That's what we are getting.
Yes, sir.
Okay, so let me quickly make that adjustment. 188 300. Okay, thank you so much. So that's what will give us profit before interest and tax. Or hold on, please. Let me go back and check something. I hope I've not made mistake. Okay, please 1 minute. Operating profit is okay. We are actually supposed to do 180 200. That's operating profit. Please 180 200. No, that shouldn't be.
That will be profit before tax.
That's profit before tax 180, 200. That's what we're supposed to use. So please take note of that. Thank you so much. That's profit before tax. So that's been given. Then we are going to add or less. So where there are depreciation charge during the year. So quickly, let's go. We don't have time again. Please let me quickly create a link. Let me quickly create a link. I'll get back to you now. Please don't go. Let me quickly create a link. Don't go.